Forget the flashy suits and the wolves of Wall Street. Michael Burry, a name synonymous with the book and movie The Big Short, marched to a different beat. This soft-spoken doctor turned investor rose to fame with an audacious prediction: the 2008 housing market collapse. But is he a visionary prophet or just a lucky gambler? Let's delve into his story and see if his voice, once a lone wolf's cry, deserves a place in the modern financial landscape. Michael Burry's story isn't your typical Wall Street narrative. Graduating from medical school, his fascination with the financial world led him to the path of value investing, a strategy pioneered by Benjamin Graham and practiced by millions today, including legendary investor Warren Buffett. This approach emphasizes finding undervalued assets, those trading below their true worth. Value investors meticulously research and analyze companies, seeking a margin of safety by buying assets at a significant discount. Burry's fascination lay in this contrarian perspective. He actively sought opportunities where the market's over-optimism marked underlying weaknesses. This independent thinking is vital in value investing. So, fueled by these principles, Burry meticulously researched the housing market in the mid-2000s. While others saw a seemingly endless boom, his keen eye spotted cracks beneath the shiny surface. Easy access to subprime mortgages was inflating housing prices beyond their inherent worth, creating a ticking time bomb of unsustainable debt. Burry didn't just observe, he acted. Convinced of an impending disaster, he made a bold move, a massive short position against the housing market using credit default swaps or CDS. What does it mean? Let's break it down. Taking a short position or shorting involves borrowing an asset like a stock or bond and selling it immediately, hoping to repurchase it later at a lower price. If all goes well, the potential profit is the difference between the higher selling price with the borrowed asset minus the lower repurchasing price when it's time to return it. Next, credit default swaps or CDS are like insurance contracts for debt. Imagine if you think that someone might not repay his loan to you. With CDS, you pay a regular fee to another party who agrees to compensate you if that happens. In Burry's case, he purchased CDS tied to mortgage-backed securities or MBS. These bundles combine many individual mortgages. Burry essentially bet against the housing market, believing the inflated house prices would come crashing down and widespread defaults would occur. He paid a premium up front, but if his prediction was right, the payout from the CDS would be much larger. Naturally, with market over-optimism, Burry's daring move was met with ridicule and skepticism from established financial experts who didn't have his foresight. Fast forward to 2008, the housing bubble burst spectacularly, and the financial world went into a tailspin. Burry's seemingly outlandish gamble paid off handsomely, with him taking home an estimated 100 million USD, while his investors pocketed a whopping 700 million USD. His story became a symbol of defying conventional wisdom and the power of deep independent research. The book and movie The Big Short further cemented his reputation as a financial maverick. Michael Burry continues to be a vocal critic of the current economic climate, particularly the potential for high inflation and another market crash. In recent years, he has expressed anxieties about high inflation and the potential for asset bubbles, particularly in sectors like electric vehicles, and continues to warn about the unsustainability of the market rally, drawing comparisons to the pre-2008 housing bubble. Burry maintains his bearish stance and argues that the Federal Reserve's quantitative easing or QE programs, which involve large-scale asset purchases to stimulate the economy, might be creating an artificial bubble in various asset classes like stocks and bonds. This bubble, he believes, could eventually burst, leading to a significant market correction. He even went as far as to tweet that the Fed has no intention of fighting inflation. Now, Burry's predictions are often met with a mix of intrigue and skepticism. While the market has experienced periods of volatility and corrections since Burry's initial warnings, a full-blown crash hasn't materialized so far. And while his concerns hold some weight due to his past success, critics argue that predicting the market with pinpoint accuracy is a near impossible feat. While his 2008 prediction proved remarkably prescient, it doesn't guarantee future success. However, dismissing his voice entirely would be a mistake. His unwavering focus on value investing, meticulous research, and willingness to challenge the status quo offer valuable insights. Financial history is littered with examples of experts who missed significant downturns. Michael Burry serves as a constant reminder that sometimes the most valuable lessons come from those who dare to think differently. Whether his current concerns materialize or not, his story emphasizes the importance of independent analysis, a healthy dose of skepticism towards prevailing narratives, and the potential rewards that can come from challenging conventional wisdom. Do you think Michael Burry will be proven right again? Share your thoughts in the comment section below. Be sure to like, share, and follow Do Academy for more actionable investment insights.